let's also welcome Sudip Bandyopadhyay, Group Chairman at Inditrade Capital. Hello, sir. Welcome to the show. Now, good morning, sir. Now, sir, since we touched a low of around 18,837 or so on Nifty on October 26, the markets have rallied by about 900 points, and we have seen a good bit of consolidation also, in the last 3 or 4 sessions, where maybe we have not moved up as much, but we are not, we have not fallen as much either. What's your view on Nifty? A significant close above that 19,800, which a lot of technical experts are saying is a make or break level. Can we perhaps make way towards that all-time high levels?
Yeah, absolutely. I think look at the way the market is poised. Look at the way the global developments have taken place over the last, I would say, about a week, 10 days time. The scenario in US is now completely changed. Look at the commentary of the large global fund houses about 15 days back and now. I think previously they were talking about higher for longer. The oil prices were shooting up. And all kind of thing was happening, and the risk aversion was at probably close to its peak. From there, the data started coming, which clearly showed that the U.S. economy was doing better than what was expected. The inflation also was much better, much lower compared to what was expected. Now, this has now led to a complete U-turn in the sentiments in US, where now they're talking about, there's no question of higher for longer. The question is when the rate cut will come. And by and large, the consensus is that, towards the second half of next calendar year, US Fed will probably go ahead and reduce the rates by 100 basis points. Now, this is a completely changed scenario. Risk on mood is coming back gradually. US yields are softening. Oil prices have come under control. This is not again touching 95, 100 and all. It's went below $80 per barrel Brent, and now it's hovering around 82. So I think the overall risk on mood is back, and that's leading to FIIs participating in a big way once again in Indian markets. We may not have seen the reflection in the numbers of buy, but they have reduced the short significantly and probably started getting on the long side as well, as the data shows of last few days. So I think the FII change of mood has definitely helped Indian markets, come to these current Nifty levels. And I believe that with the macro indicators, domestic macro indicators also falling in place, corporate results being by and large better than expected, there's no reason why we should not scale newer highs.
All right, sir, as you rightly mentioned, a lot of the global brokerages are expecting a 75 to 100 BPS cut by second half of 2024. But I mean, I was listening into Mr. Powell and team, the minutes that came out, it indicated that US, while they might be done with rate hikes for now, they are still a little apprehensive about, and they don't really have that appetite for rate cuts. And monetary policy, at least from what they are saying, at least it looks that it will remain restrictive. But the market is expecting a 75 basis to 100 basis point cut. And on the back of it, we have seen a tremendous rally across the board from US markets to emerging markets as well. But, what do you make of Fed's comment? Do you think that, like this comment about, keeping rates and monetary policy restrictive, will that hurt the sentiment?
Not really. In fact, if you see US markets yesterday, the markets did really tank after the Fed minutes were out. And if you look at the bond market, I think bond market by and large, to a great extent, I would say, discounted and ignored the comments. See, the writing is on the wall. The Fed will have to keep taking a stand whereby they don't let the expectations run ahead of the reality. So they have to be cautious in their statements. And that's what pretty much all the central banks do. They have to ensure they need to talk to the market rightly. And Fed is doing that. So I don't think we need to read too much into the Fed minutes of yesterday. I think the data is what will drive Fed as well as the markets. And the data very clearly shows there is no need, no rationale for any further hike or keeping the rates high beyond a point of time. Now, if the data continues to support this thesis till, let's say, the first quarter or the middle of second quarter in the next calendar year in US, I think there will be tremendous pressure on Fed to really come ahead and cut the rates the way it is being anticipated.
All right, sir. I mean, to your point, what do you think is on cards? Can we expect a 75 basis to 100 points cut by the mid 2024?
Yeah, absolutely. That's exactly what my belief is also. But it'll all depend on the data, how the data comes. As I was saying, over the last 15 days, the entire scenario has changed based on the data. Now we'll have to carefully watch the data.
Right.
And the joker in the pack, I would say, is the geopolitical situation. That also will play a significant role going forward. So we have to carefully monitor that.
Now, sir, you rightly mentioned that the three major forces, the three horsemen as we call it, oil prices, your bond yields in the US and the dollar index, they have moved in favor of the equities, and there's a risk on sentiment for the equities. And emerging markets is benefiting from it. Even in November, Nifty is up, I think, around 4% or so, but we are still relative underperformers compared to South Korea and Taiwan. Do you expect that to change perhaps, because our earnings season has been phenomenal, 14 to 16% earnings growth. I mean, far exceeds the kind of earnings growth you would see from a Taiwan or a from South Korea. So what's your call over there, sir?
Well, the way I look at the entire emerging market, or particularly this, Taiwan, South Korea, China, is that India is a strategic long-term bet, whereas some of these markets, including China, is a short-term tactical bet. If
Right.
you look at the valuations, I think the valuation-wise, India looks rich. When you compare them with other emerging Southeast Asian markets, including China. And some of the, FIIs are a very broad universe. There are, hedge funds, there are, arbitrage funds, there are short-term funds, and there are long-term funds, pension funds, and others. Now, the long-term guys will definitely continue to keep betting on India and moving money to India. As far as the short-term funds and guys who have a short-term horizon, they will take a tactical step and probably move money into China, Korea, Taiwan, because the valuations there look attractive, and probably there is a rationale for valuation improving in these markets faster than they will probably improve in India at this stage in the short term.
All right. Sir, I think one of the questions I think is imperative for a retail investor over here is, we are talking about tactically, shifting your allocations in the short term. Can retail investors do that in the market? What's the best way for them to gain exposure to, let's say, a US market or a Taiwan market?
Well, I think there are funds, as we all know, there are mutual funds who have introduced schemes which invest in US markets and some of the other emerging markets. But unfortunately, the performance as far as other emerging market funds are concerned hasn't been anything great. And I won't really advise Indian domestic retail investors to try and take benefit of this short-term trend in the other emerging markets. US markets, of course, people have made money, funds have done very well. Obviously, US markets have done very well. But if you're talking about trying to benefit out of this short-term blip or short-term upside in Taiwan, China, South Korea, I think let's watch these from the sidelines. Let's focus on Indian markets. We still have enormous potential as far as short, medium, and long term is concerned in India also.
All right, sir. Another thing that fell on my radar was that Jio Financial Services has submitted an application to Reserve Bank of India for conversion of the company from an NBFC to core investment company. Now, can you help us understand what does this mean? Is it a nomenclature change, or the business is going to change for the company?
Well, I think what they're trying to do there. In fact, the plans which they announced, they're talking about an insurance company, they're talking about asset management company, they're talking about other types of lending and other financial activities. Now, if they have to do that, they need to do it under different licenses. Probably all this will become subsidiaries of Jio Financial Services. Now, as we understand the core investment company regulations, if an NBFC or an investment company has about 90% plus of its assets in investments in other businesses, so it becomes it needs to be classified as a core investment company. I think that's what they are trying to do. So I think structurally, what they're signaling to the market and the RBI is that Jio Financial Services will become the umbrella holding company for a clutch of financial services businesses.
Now, sir, it's a flurry of IPOs opened in today's date. I think 4 IPOs have opened, and Tata Group's first IPO in nearly 20 years in the name of Tata Technologies has also opened for subscription. And even I was looking at the financials. The company is debt free, has a good presence in the R&D space, but there's a high concentration risk as 40% of its entire revenue comes from Tata Motors and JLR. Do you think that is the reason why the company's valuation, the valuation that they are asking for, is significantly reasonable compared to peers?
Yes and no. I think, and that point is valid. They have 40%, 38% of business coming from Tata Motors plus JLR. But also, I think they're leaving a lot of stuff on the table for the investors to benefit. Tata Group has been known for their superior corporate governance practices, and I'm sure this has played a role in the pricing of the issue as well. As far as Tata Tech is concerned, I think it's a superb company. Engineering R&D is a niche area where there are few peers. If you look at the breakup of their revenue, 50%, almost 50% comes from the automobile sector. Another 30% is coming from aerospace, balance from heavy machinery sector. Now, look at the automobile. The biggest transition in our lifetime. Why in our lifetime? Maybe in the entire auto industry's lifetime is happening. The transition from ICE to EV. And now this transition, there's a big role for an ER&D company operating in this area. And that is the niche where they are operating in. Again, if you look at aerospace, I think there is a significant amount of changes happening. This sector is booming, and we are talking about private space travel. Now, under these circumstances, this is another area where there's tremendous potential going forward. They operate in this area in the ER&D space. Now, I think these are fantastic areas to operate. There's a great track record they have established already. This is not a new company they have incorporated and started. This is a pretty reasonably old company, 94 vintage, and they have a track record of delivering, performing, a strong balance sheet, great parentage, good credentials in the market. So I think it's absolutely fine to go ahead and apply for this IPO. To the specific point of the concentration of business, I think they will diversify. And look, today I think JLR and Tata Motors are a leading player in EV in India, and globally also they are trying to become. There are not too many EV players. Also, this company works for Tesla. They works for VinFast. So other leading EV companies. So I'm sure they will diversify going ahead, and it will be a more diversified revenue stream going ahead. So we should not get too perturbed with this 40% concentration risk and things like that. I think it's a great company coming at a great valuation at the right time and in the right sectors.
All right, sir. 3 other IPOs are also opening: Flair Writing, Gandhar Oil Refinery, and Fed Bank. Between the 4, what would be your order of preference? Tata between the 4, including Tata Tech, I mean.
So Tata Tech definitely will be number 1. I think I would also look at Gandhar and Flair, and finally Fedfina. Not because one is better or worse, just the fact that I think the potential for upside based on the valuations at which they are coming in and the opportunity, considering the export. Gandhar's 50% revenue comes from export market, international markets. I think that's a very good thing to have under the current circumstances. To a great extent, protects them from currency fluctuation and a whole lot of other things. The opportunity size is humongous. The entire, most of the FMCG products need soaps, shampoos, creams, all that needs the base oil, which is white oil, which is Gandhar's, Gandhar is supplying. They're a very strong player in the industry with great track record. As far as Flair, it's a very well diversified business into stationery, writing instruments, and other things. The brands are strong, and there is again a significant potential with we know how India is developing, what kind of penetration of education and educational requirement is happening, and the kind of focus government and the private sector has on education. So I think the scope for flair also is good. As far as Fed Finance is concerned, they're talking about catering to the unbanked segments, and that is their focus area. That's what they're clearly saying. I think it's a good niche. There is competition, there are challenges, there are asset quality issues in this particular segment from time to time. So while I don't want to take anything away from FedFina, but if you ask me to rank them in order of preference, that will be my ranking.
Right. So that's Sudeep sir for you. Sir, always a pleasure talking to you. Appreciate your thoughts, sir.
Thank you.